Good morning, everyone. My name is Nareed Altman, and I'm your 2021 NAIOP Chapter President. I'd like to welcome you all to the second of our Back to Basics event series, our Toronto office panel. We have a great group of panelists here today, and I know we're all looking forward to hearing their insights on what's really happening on the ground in the Toronto office market. But before we do that, I have a few NAIOP updates that I wanted to share. Our first professional development course of the year is coming up on March 25th, titled Jumpstart Your Why with renowned business consultant Simon Sinek. Participants will have the chance to sharpen their professional development skills with live coaching from the Simon Sinek team. And I personally participated in our last Simon Sinek event and thought it was one of the more worthwhile webinars I was part of last year, so I would highly recommend it. Secondly, I wanted to let everyone know that there are volunteer opportunities available with NAIOP, and particularly on our Rex Awards committee this year. So for anyone who has interest in volunteering, you can go to the members section of our website, where there's a new feature that enables you to enlist your interest in volunteering. Lastly, I just wanted to let everyone know we're doing something a little different for the Q&A for this panel. So at the end of the session, you will see a separate Zoom link in the chat feature, which you can click on, and it will take you to a breakout room with one of our panelists, which will allow you to ask questions and chat with your peers in a smaller forum. So I hope that you all stick around to participate in that. Now, that's about all from me. So I'm going to turn it over to today's moderator so we can get started. John Ramscar, Executive Vice President, Managing Director at CBRE. Over to you, John.
Thank you, Nareed. It's a great honor to be able to talk to the office market today. And so good morning, ladies and gentlemen. On behalf of the NAIOP Greater Toronto Chapter, I'm very pleased to welcome you all this morning to the much anticipated Back to Basics in Toronto's office market. Never have we seen such uncertainty and divided opinions surrounding the viability of long-term office use. Whilst our personal and professional lives have changed dramatically over the last 12 months, we gather today to better understand if we are experiencing a one-time event or rather facing a structural shift in the office markets. We intend to separate fact from fiction and focus on the true reality with today's esteemed panel of experts who have been kind enough to offer us their time. But before we do that, let's take a moment to review the current office narrative and set the context for today's session on Back to Basics. This time last year, we were all sitting in the Toronto Board of Trade. The focus was on preparing for the roaring 2020s with a highly competitive 1.8% vacancy rate, the lowest office vacancy rate in North America. We commenced the new decade with a significant momentum with heightened appeal for candor on the world stage, moving beyond our country's long-standing safe haven thesis to one of more of a primary investment destination. The onset of the pandemic switched on a spotlight over the office sector like never before, with much media-fueled hype around the death of the office, as we were all forced to embrace a new way of working. But as we all know, actions speak louder than words, and the credibility of these headlines was soon undermined. Amidst the media-fueled hype, we've witnessed vacancy rates climb from the all-time low 1.8% last year to 7.2%. Driven in large part by a historic jump in sublet availability, sublets accounting for over 40% total vacancy. The significant rise in sublets has created a bifurcation in the market with questions surrounding the real vacancy rate as landlords sway towards the 4.1% direct rate and tenants towards the all-encompassing 7.2%. There is much widespread speculation around the future of Toronto's vacancy trajectory, with the long-term structural impact of working from home still to be understood. For example, if nothing else changed, a 10% shift in demand could have a 400 basis point impact on our vacancy rate over the next few years. However, we know many more variables have to be accounted for, some of which may offset such a change. Additionally, leasing demand and immigration growth is expected to pick up significantly in the second half of this year and into early 2022. It's important we all remember that rising vacancy is not just a Canadian or Toronto market issue. It's a global trend right now. Toronto remains competitive and currently sits at the second lowest vacancy rate in North America. To put this in context, Manhattan, Seattle, Washington, and San Francisco are between 11 and 17% respectively. Diving a little deeper, it's clear the impacts are not felt evenly, with over 80% of sublets comprising less than 15,000 square foot tenancies, with the tech industry representing over 30% of sublet inventory. Despite much negative sentiment, Q4 2020 witnessed over 600,000 square feet of new leasing alone, with a number of high-profile long-term commitments executed in the marketplace. At the same time, a significant number of office investments transacted at the end of 2020, reinforcing confidence in the long-term outlook of the office sector. The year witnessed a rise of the private investor pool, comprising of over 40% of 2020 transactions across Canada, highlighting the appeal of direct real estate to private capital during times of uncertainty. Global investors know every local real estate market has its idiosyncrasies. Yet Toronto's downtown office market fundamentals are like no other in the world. Our downtown oligopoly structure is being tested, with the pandemic stretching patient capital and the depth of the institutional purse. Collectively, this ownership group controls close to 70% of the marketplace, leading some extremists to proclaim we are the Saudi Arabia of commercial real estate. As such, rental rates continue to hold firm, with institutional investors heavily focused on preserving net asset values. We know the supply side well, but it's the demand side of the equation which is ambiguous. Whilst the impact varies across industry, the trend is focused around a wait and see for those that can strategy. Many CEOs continue to keep their options open after stabilizing operations and are now looking to address their employees' needs in their real estate. Key areas of focus around cost-saving measures, flexibility, de-densification, hub and spoke formats, and the quality of building services and amenities are high on the list. Health and well-being becoming an increasing priority as data starts to emerge, highlighting the detrimental impact to employees' mental health since the onset of working from home. As we remain committed to the stay-at-home order, it's too early to predict with real certainty what the future of the office will look like, but it's safe to say the future is not binary. Guidance continues through qualitative surveys, with CBRE's latest global research finding 67% of employees desiring a balance of office and remote work. While it's clear there are challenges ahead, the end is in sight and there is good reason to be optimistic. Canada's employment growth is forecast to double the G7 average over the next few years. And immigration, along with Canada's affable lifestyle, continues to attract talent. Toronto is well positioned and continues to boast the title the fastest growing city in North America, and long may it last. It is with this context in mind that I'd like to introduce today's panel for a discussion around back to basics in Toronto's office market. First of all, Alan Mckenzie, CEO, JLL Canada. Alan is responsible for developing JLL Canada's business strategy, driving revenue, delivering best-in-class services to clients, and partnering with the company's business in the Americas and globally. Based in Toronto, he leads the business and its adoption of new technologies across Canada. Secondly, Gordon Wadley. Mr. Wadley is the Chief Operating Officer of Dream Office REIT and the EVP of Commercial Properties at Dream Unlimited. Mr. Wadley provides leadership to the overall asset strategy of Dream Office REIT's national portfolio, as well as all income-producing assets and stabilized developments at Dream. And finally, Nick McRae. Nick is a Senior Portfolio Manager, Real Estate for Healthcare Ontario Pension Plan, one of Canada's largest pension plans. Nick and his colleagues are responsible for managing all activities of the $15 billion global real estate portfolio. Nick has direct responsibility across several asset classes in North America and Europe. And so on that note, I'm going to open up the panel discussion. So good morning, gentlemen. There's certainly a lot we can cover here, and we only have a finite amount of time, so I'm going to plan to move us all quickly, but I'm going to start with the key topic right now, which is the rising vacancy, what's really happening. As we know, vacancy has increased well over 5 million square foot since March 2020, with sublets accounting for over 40% of total vacancy. How have you been working with your tenants and landlords to work through this challenge? And I'm going to start with you, Gord, first of all.
Well, thanks, John, and I hope everybody that's watching today is doing well. I hope your families are all well, and I appreciate being with you all today. You know, back to your question, you know, for us, it's not rocket science. It really came down to two core pillars, and quite simply, that's just communication and empathy. I think early in the pandemic, what we did is we simply dedicated team members, we reallocated resources, we adjusted our KPIs on the fly to ensure that we stayed in constant communication with our tenants. This was really to be a resource, you know, a sounding board, and ultimately be a partner to help facilitate and manage their occupancy decisions. In large part, by having these lines of communication, we were able to collectively come up with a plan. And this helped us and our clients avoid knee-jerk decisions to throw space out on the sublet market. If you're communicating and offering solutions, you mitigate the likelihood of having a client or partner walk away or think their only alternative is to sublet. And on the back of this, we had some great success on direct renewals. It also helped us provide guidance on government subsidy programs and in turn be a very active and most importantly, and I say this, most importantly, an empathetic partner in making payment arrangements. And I think it's a reflection in our numbers, which on average, our collection ratios have been over 97% throughout to this day. So in the end, it's ultimately nothing more than we just wanted to be a partner to help navigate through this. And we took the approach of let's collectively plan first and then pay second, instead of going silent and expecting to get paid. Landlords throughout this pandemic have had a real opportunity to show how valuable of a partner they can be. And I think it's really resonated, with our clients and a number of clients of my peers and in the brokerage community as well. So really, it's nothing more technical than just good communication and being an empathetic partner.
That's great. It's a great reminder, Gord, of the importance of communication. And I'm going to turn the same question to you, Nick, as well, in terms of how you handled through the transition.
And maybe just to start off, I'll echo Gord's comments on hopefully everyone's families are healthy and safe. And thank you also for having me. And really, the only thing I would add to Gord's comments, because I think there's a lot of consistency there, is when we started talking to our tenants, the key we sort of came back is they don't know either. And so, in a lot of cases, there is no clarity on what their intentions are, and they're really hyper focused on the safety of their employees and really enabling their employees to continue to run the business in this remote work environment. And the perspective I'm going to try and bring today, just in general, is as a global investor, sort of see how we're seeing things around all the markets we're investing, try and tie it back to Toronto a little bit, and hopefully add some perspective and context. And I would say that was the case across our entire portfolio, where really tenants, we made ourselves available, but largely speaking, they're really focused on their internal operations, manage their people, enabling their people, and also coming with feedback of they weren't sure yet either. And I think that remains the case today, where most of our tenants aren't even sure yet when they're going to be back in the office, let alone what their ultimate space needs are going to be.
That's a great segue, Nick, into the occupier perspective. And Alan, I'm going to ask you, obviously, given the the occupier accounts that you see there at JLL, what have been the common themes from the occupier side?
Thanks, John. I will also start off with a thank you to NAIOP for inviting me. And John, thank you for your hard work in preparation for this as well. And good to see you, Nick. Good to see you, Gord. So here's the thing with what's going on with on the tenant side. Yes, instead of a lot of 5 and 10 year renewals, we're seeing 1 to 3 year renewals. So the terms have been shorter at some point in time when tenants have the opportunity as well, just because of business risk and the unknowns that Nick was talking about, to giving back space on the renewals as well when they have the ability to do that. And you did reference, it's interesting in your opening slides, John, you did reference that the majority of the sublet space is made up of tech. But tech itself is actually bifurcated as well. There's big tech and there's new tech, effectively, right? So the young companies and the old companies. And the young companies are the ones that are obviously, their business models themselves are still somewhat unproven. They're a little bit more volatile. They're answering to their investors and their board members a lot closer than some of the big techs who are more mature. Quite honestly, the big techs who we represent are asking us about, is there an opportunity for us to spring onto the market because there are some further incentives, or there's availability of space we previously wouldn't have had access to, or potentially there's some good financial deals as well. So it's a little bit all over the map, but on the renewal side of things, yeah, a lot of 1 to 3 year renewals. Yeah,
it seems to be the common theme. And Alan, I'm going to stay with your point there on tech, and I'm going to come to you, Gord, in terms of how have you found you've had to adapt or shift focus now going forward, given some changes in industry through this experience, particularly around tech?
I mean, I think if anybody's chasing tech in their portfolio or has a preference to chasing tech, I think they're kind of setting themselves up for a little bit of failure. And I think the pandemic's been an inflection point to illustrate that. We just want to do good deals, and we're active in the market. And to Alan's point, we want to appeal to occupiers, and how we've been marketing our space throughout the pandemic is really putting an emphasis on base building systems, how a landlord can mitigate risk for their clients. I think is just as popular as a marketing piece as traditionally a couple of months of free rent or a bonus TI has been. You know, it all comes down to risk mitigation and being able to demonstrate what you're doing in the building from a base building perspective. You know, M&E's at the forefront. You know, also, what are your pillars in terms of sustainability and ESG? Like, sophisticated tenants want to align themselves, you know, to a brand and to a value proposition, and that goes beyond tech. So we've really been focusing on all the businesses. We don't differentiate between tech and professional services, and our goal throughout this has just been to really put a focus on how we're going to mitigate risk for these clients, and let them know that they've got a really safe work environment that they can be a part of.
Yeah, that makes sense too. It certainly instills some confidence there, and we're going to keep moving through here. And obviously, a big topic of debate right now, and a huge part of the office narrative, is this kind of disconnect and bifurcation between direct vacancy or real, what is the real vacancy, with the amount of sublets that we're seeing. And Nick, wanted to get your thoughts on that. I know you said a lot across a number of global markets, but would appreciate your thoughts on what is real vacancy right now downtown.
Well, clearly you've seen, both vacancies start to move up in a meaningful way, and across markets we've seen that, whether it's 100 basis points or 500 basis points, and subleasing has really led that spike. It has to be viewed as competitive space, and I know there's terms involved and shorter terms from a 10-year perspective and maybe some restrictions. But in this environment, especially if tenants are looking for more flexible options, I think that's less of a constraint, as well as looking at it as a leading indicator of directionally where tenants are going. And I think back to the uncertainty, I think a key point is whether tenants are renewing or moving. We're not seeing any of them really take an expansion space. It's generally sort of renewing their current number or reducing space or trying to move into space to be more efficient. And so that sublease space, I think, has to be factored in as a meaningful number, and also as a leading indicator directionally of where the market's going. As we've seen with markets that have struggled over time, that sublease vacancy tends to transition into head lease vacancy. So it's highly relevant, and especially from a signaling perspective.
Absolutely, it's definitely the wait and see for those that can. Continues. And Nick, I'm going to stay with you here because this rolls in nicely into, obviously, vacancy is increasing, and we've seen a significant lift, and certainly comparative, and this is a global trend as we touched on. But why are we not seeing rents move as a result of rising vacancy?
And maybe just I'll touch on the tech question a little bit to lead into that. Both tech and flex office, which we're going to touch on a little bit later, but those were two of the largest take-up occupiers in most major markets in the last number of years. And tech specifically, we viewed, as we thought about office markets, prior to COVID, that we just viewed that as a major opportunity and risk, in that if it slows down, what's the outcome? Now, through the pandemic, interestingly enough, there's been some very large announcements from tech users, whether it's Facebook signing a major lease in New York, whether it's Microsoft buying a major campus in Seattle. However, I think we have to be really cognizant that there's also a lot more flexibility for tech tenants, just given the infrastructure and the agility they have. And so that's a key element. Now, how does vacancy translate into rents? Sort of going back to your question, I think the first part of the answer is there haven't been any leasing deals. There's been very, very few leasing deals. So there's just not a lot of comps to come on to compare against. And in large part, we're sort of seeing, the face rates stay consistent. But I think that's partly because there's been a lack of evidence that they've changed, as opposed to, reinforcing those numbers. Secondly, there's face rates and obviously net effectives. And face rates, you did mention in your intro about preserving asset value, and clearly in the institutional world, there's an element of that. But net effectives are really the underlying economic rent, and that's the key number we spend time on, because fundamentally, if you're giving all your face rate back in inducements or free rent, that's the sort of the underlying economic performance of the asset. And I would say, anecdotally, we're seeing those inducements increase, whether that's free rent or just higher inducements for build out or what have you. Those are increasing, which means the effective is going down, and so that means they are being impacted. I still think, again, we're in very early days, and especially when you consider 2020 was a write-off from an activity perspective, 2021 will be telling.
Yeah, just to jump in, John, I think Nick's made two really good points in what he just said there. So one is about NERs. So we're maintaining our face rates. We've seen quite a bit of activity in deals. I don't mind sharing. We've done over 70 deals for close to 600,000 square feet. Over the course of COVID, and we're seeing some large deals get done. A couple of expansions. 4 of those deals were over 25,000 feet. One of the deals was over 190,000 square feet. While the velocity in net new deals were down versus prior years, we're achieving and surpassing our renewal targets, and we're seeing and preserving our net rents. But to Nick's point, we are seeing a trend of softening NERs, and for a variety of reasons. Tenants have their own capital constraints. And part of being a good landlord and a good partner is finding a way to work through those constraints to put a deal together that works for everybody. And a lot of the times, to preserve asset value, getting those net rents are key. And we've seen a bit of slippage on some NERs as a result, as I'm sure a lot of our peers have as well, as doing these deals. And then back to the point about subleasing, I think where we're going to see a real kind of inflection point on subleasing is going to be in June. And I think we're going to see it around the B and the C class markets. If you look at the influx of the government subsidies right now and what the qualification thresholds are for CERS, used to be SECRA, there are a lot of small cap businesses, a lot of smaller businesses, and a lot of them are relying on those subsidies. And the bulk of the people that are relying on those subsidies are in these B and C class buildings. And a lot of those B and C class buildings in turn are pretty functionally obsolescent. So they're almost catching up on the base building side, but they're also going to have this inflection point in June where a lot of these rental subsidies are scheduled to start to come off a little bit. And I think in those class of assets, we haven't quite seen the tip of the iceberg in terms of what the true availability is going to be.
It's a great point, and it leads us into the building quality discussion, which I'm going to come back to shortly. Nick, I can see you're eager to.
Well, yeah, and one other element I'd just like to add to Gord's point is, my comments around leasing activity are broad, and we're seeing it across all the markets. But the other component of it is each market has its own supply and demand dynamics, and so it's important to remember where we're starting from. And so, Toronto being a prime example, and you mentioned your introductory remarks, strongest office market in North America, are arguably potentially in the world in terms of just how tight the market is. So an increase in vacancy in of itself doesn't necessarily put you into a tenant market. And we had a couple of early renewal discussions last year where our view was, ultimately, this particular tenant didn't have a lot of options. So we're happy to sort of figure out a deal. However, it's not an automatic discount. So there's an element of that in market by market, and then within the market, there's distinctions between A and B and C, which I think Gord mentioned. The market, there's not just one vacancy rate for the market. It's really the class of space and the quality of space you're looking for that's going to be a driver. So notwithstanding there's these macro elements at play, the micro of supply and demand at the local level is always going to have a huge impact.
Yeah, the grassroots fundamentals, absolutely. And I'm going to open up Alan now, just from particularly on the occupier side and what you're hearing.
Yeah, appreciate that. These are all really good comments, and actually it has me thinking live at the same time. Just talking about the sublet space, I'm going to start off there, John, if I may, and we have a lot of knowledge of that because these are tenants that are trying to lease space, and we represent a lot of tenants that are trying to lease space. So many of our tenant rep agents have turned into agency agents overnight in the last year as well. But here's the thing, and here's what's going on live as we speak. And I can speak of a situation. I won't speak of a situation, but I can think of a situation that just occurred yesterday where, yes, it is real vacancy. I agree with Nick, because it's an opportunity for a tenant to move into that space. So it's real, whether you call it availability or vacancy. To me, it's the same thing. It's an opportunity for somebody to lease the space. What's happening is that these people are obviously trying to save some money with an unknown future, needless to say. But what also is happening is that many of these tenants who tested the market and are seeing if they can recoup some costs by shrinking some space with an unknown future are actually now, don't forget, we're 11 and a half months through. It was Friday, March 13th, I guess it was last year, right? So we're almost 12 months through COVID. And they're realizing that they didn't go out of business. Their business continuity plans were successful. And maybe we're going to get back, as Gord said, by June 1st or later on in the summer. And I think I'm actually going to need that space. So live, just as of yesterday, we're walking around with tenants in the marketplace in downtown Toronto, writing up paper for offers, only to find out from the listing agents on those sublet spaces that the tenant decided to take it off the market. The other thing that's going to happen as well in the second half of this year, and for anybody who's seen any of the broadcasts over the last month or so with economists, there's obviously going to be an economic bounce back. There's a lot of pent up demand from occupiers in the marketplace as well. So I think we're going to see two things that will help out and reduce the vacancy. One is some of it's going to get taken off the market from a sublet perspective, and some of it's going to get absorbed as well as direct space because of the pent up demand by a number of the tenants that are out there. And just think about this. I won't take up all the time, but think about the chronology of the decisions that had to be made at a lot of these tenants, especially the smaller tech tenants who put a lot of this space on the market. So March 13th rolls around, everybody's offices are closed. I think as Gord said earlier, the first thought, or maybe it was Nick, but the first thought is we have to save the lives of our employees. And they go into a business continuity plan that's all about making sure the safety and well-being of their employees are at the forefront. And then they start thinking about, okay, I know we're going to have to report to the board. I know we're going to have to talk to our capital market investor in our company pretty soon. So what are the next things we need to figure out before we have those conversations? And of course, it's all about cost mitigation. That's where they go. So they're trying to protect their top line revenue, and they're obviously trying to mitigate any sort of costs that they can try to save. And as part of those discussions, in our office, especially downtown and especially in tech, like Oliver Alves and John Pesum are getting a whole bunch of calls at that stage 11 months ago, basically saying, you're our broker, what do we do? Can we test the sublet market? Is there a market out there? And their answer 11 and a half months ago was, there's 1.8% vacancy in downtown Toronto. There's a really good chance that you can save some money by leasing the space because there's a whole bunch of pent up demand. Only for us 6 months later to realize, yeah, but the demand wasn't there and a whole bunch of space flooded. And now they're learning more about the continuity prospects of their own corporations. And for the most part, we're seeing that we're not seeing a lot of businesses going out of business. We're seeing a lot of businesses rationalize the future demand of the space. And this is where I'm going with this is we're going to see a lot of that sublet market be taken back to tenants who are going to reoccupy it themselves in the fall. And we're also going to see a whole bunch of space absorbed in the market in the second half of this year by pent up demand alone.
So maybe if I could just jump in, there's an underlying assumption there that the tenants are going to take back the same amount of space and use it on the same basis as they were prior. What are you hearing from your tenants, Alan, on work from home, flex office, hybrid approaches? Because we know it doesn't take much movement in office markets to move the needle on moving overall vacancy rate and changing the balance of power. So thoughts on that? Sorry, John, by the way, hijacking the moderator role.
The moderator, go for it.
No, it's a great question, Nick. And again, I think one of the themes for this webinar is fact versus fiction, right? So what I should share is a bit of personal opinion, obviously, but a little bit of research that JLL has done as well. We're global, obviously, in 80 countries or so, whatever it is. John, same thing with your company as well. And over the last 60 days, we've dug deep into corporations, 362 corporations in 11 countries in the last 60 days to do a bunch of research to ask them exactly what their plans are for the re-entry. In other words, the reabsorption of the vacant space they're not utilizing right now. And what we found really, really fascinating about this, and again, this is across the globe, it's EMEA, it's Asia Pac, it's obviously the Americas as well, is the big difference right now is the occupancy level of human beings on a per industry basis. And just a couple of quick facts and stats. The automotive industry, as an example, have 24% of their employees back in the office. The tech industry globally in 11 countries has only 3% of its population back in the office today. But when asked, what will your population percentages be 6 months from now in July? It goes up vastly. So automotive at the top of the spectrum goes to 54%, and tech actually goes to 35%. So it actually has the biggest bounce back. Then the next question we asked them was, all right, December 31st, New Year's Eve, what percentage of people in your organization are back in your office? Everybody's basically at the same number, and it's 90%. And again, that's 11 countries, that's 362 companies in all industry types. So if they're forecasting correctly, I think we're going to see we're going to see a little bit more normalization of the occupancy of space according to them. And quite frankly, the easiest thing for business owners to do or boards to do is go back to where they were before, because that's no change. And there's no stress on the system by having no change. And quite frankly, that's what they want to do. The unfortunate part is the world obviously is changing in front of their eyes, where the usage of the space, the work-based solutions that are coming up, the health and well-being aspects that are being demanded by their employees, and their employees on average wanting to spend 2 to 3 days at home now that they've had this opportunity, are forcing the change upon them. So what they're doing, Nick, is they're studying it. All the consultants are making a ton of money right now. They're incredibly busy trying to forecast and tell these people what they should do. The business owners and the C-suite executives are saying, holy smokes, that consultant just said that we got to leave everybody at home, or we should move to the suburbs. Oh, like, we're in the tech business. We're just trying to sell widgets. So now what do I do? And that's exactly where they are. And I said this on the panel when we were doing our dry run last week. The best way that I can sort of metaphorically give an example of where a lot of this stuff is if you can picture walking onto your driveway with a box of golf balls, and you throw the golf balls up in the air and it's going to hit pavement. Well, half the balls have hit the pavement and they're going in various different directions and settling on hypotheses of how they should come back to the office. The other half are still up in the air. So I still believe, and we still believe, we've got another at least 12 months before a number of these companies, put a pin on the dartboard as to where they're going to end up. And then we have to also remember that many of these occupiers still have 3, 4, 5, 6, 7, 8, 9 years on existing leases that don't provide them the opportunity and the flexibility to actually do anything from a workplace solution other than try to fix and upgrade some of the existing space that they have. So sorry for the long speech and answer, but it's a complicated question and I need a little bit of detail.
It is a complicated question, and it's certainly a key one right now. And I think we can all agree we anticipate some form of snapback on the sublease vacancy. It's just a question of how much. And I know we've seen as an organisation from the UK business which we've not seen. And as we step back in Toronto, we never got that rally back downtown into the downtown core, whereas London was on that trajectory and quickly became over capacity. As we remember, we're tied to that 40% for most of us. For the most part, it's very easy to go over that line pretty quickly, and you get into the over capacity range, and then you've got challenges with your space. So we've not seen that here in Toronto yet, but this is obviously going to be another stage in our journey, certainly over the next 12 months.
You know what, but I would say, John, just to add on real quick, from a micro perspective nationally, we've got assets in a number of different markets throughout Canada, and areas that are opened up or more evolved in their opening programs. There's deals getting done, there's people touring, and there's a lot of activity. Saskatchewan, for example, we're responding to 3 RFPs right now, north of 80,000 square feet in aggregate. So as different areas are opening up, you're going to see more and more velocity. And I think by nature, everybody is guilty of it. They gravitate towards a hot take, and whatever they see in the media about sublet space and the influx of sublet space. But Alan made a hell of a point, and I've heard it from a number of brokers and a number of our tenants that have put some sublet space on the market. At the end of the day, when it comes time to make a decision to dispose of the space, more often than not, they're not doing it. And just to give a little bit of context, we've got 5.5 million square feet. We have 100,000 square. We track this very closely. We have 103,000 square feet of sublet space. So our sublet space in our portfolio is less than 1.8%. So I think it's not as pronounced as everybody's saying. I think sophisticated tenants are taking their time in making decisions. And then I think there's value in having a good broker or someone that can help you navigate through these decisions and keep you on the right track. So I agree with a lot of what Alan said.
It's a great point. And I'm going to spend a little bit more time on this occupier discussion because it is such a valuable component right now, an important one in the current narrative. And I want to just kind of turn to, because it's a good segue into the next section around paying for premium space. Gord, what are you seeing right now in terms of the current market today, in terms of tenants willing to stretch in your discussions, portfolio?
Yeah, Alan can probably get a bit more perspective on the tenant, but my take on it and what we're seeing is decision makers, they're always going to be prudent on any significant capital commitment. But ultimately, I'm a firm believer that people will pay more for quality, especially when the premium on this is, or the cost premium is coupled with a sound value proposition. If a business is going to pay more, they're going to go beyond aesthetics. For example, they're going to want to know what a landlord's doing to mitigate health and safety risk. What's their 10-year capital plan? How are their ESG initiatives and sustainability goals aligning to their brand? I think tenants are savvy. I think they're very sophisticated. And in fact, I know tenants will pay more if there's an alignment or an association with their own ideals and principles, and ultimately how they want to convey themselves or be seen as community stewards, not just to their staff, but to their clients. And good quality space in the core can be a real supporter of this. And then just looking at it from a deal perspective, even in the height of COVID, we'd see this consistent observation that subtenants, especially on renewals, for a variety of reasons, they have their own capital restraints, and they're willing to pay a bit more net rent to offset those capital obligations, getting back to Nick's point earlier about NERs, to refresh or reconfigure their space. Obviously at the end of the day, it's all based on covenant, but this is a good opportunity. In fact, it's a golden opportunity for landlords that are in a good liquidity position to work with their tenants on their space requirements and achieve the rent and the term that they covet for the values. And I think, again, just kind of in closing from a landlord perspective, unless there's a mitigating circumstance, or you're in a precarious liquidity position, or you're having trouble accessing capital for whatever reason, now is not the time to be cheap. Asset managers are going to earn their money on putting together, viable 10, 20-year capital plans. I'm absolutely adamant that going forward, one of your best marketing tools to get these premiums is to illustrate your base building systems. What capacities, how much fresh air are you bringing on? How much CO2 are you getting off? What's the zone circulation? What filters are you using? Do you have touchless elevators, destination dispatch? Are you using UV tech in your cabs or lobbies? All of this is going to be as important at the end of the day. And I think people are really going to gravitate towards it. And when they see it, they're going to pay a premium. Flexibility is also going to be important too.
So stay on that note, Gord. Are you expecting that there's going to be, obviously we've touched on the uneven impact across the building classes, and the next point earlier, getting into the grassroots here of the micro level of the market. What are you anticipating? You're expecting a widening of the gap between the almost a flight to quality?
Oh, definitely, and that's what I'm going to see, and that's what I'm predicting we're going to see. There's a huge inventory in our market of B and C class assets that are functionally obsolescent. They can't compete with some of the new towers coming online, the AAA existing towers that are LEED Platinum, and I think tenants are going to pay more to be in those buildings. They have an obligation to their staff to provide, a safe, risk-free or almost risk-free working environment. And I think there's going to be a real flight to quality, and we're going to see a real division in have and have not buildings. And, unfortunately, some of these B and C class buildings, they're just not able, they don't have the floor plate capacity. It's too cost punitive for some of these independent landlords to try and do the work. And at the end of the day, all of this work in a triple net lease environment is going to be amortized, and the tenant's going to pay for it at the end of the day. So if you're a B class tenant and you're in a small building and the landlord's putting in $20 million to retrofit the building, like there's going to be cost implications on that, and it's going to be really interesting to see how that shakes out. And you're going to see some people really make some management decisions on what's recoverable and what's not recoverable. And I think good brokers and good tenants are going to be taking those things to task and really doing good evaluations on it. And, Toronto's interesting. You talked about this oligopoly earlier. Like, there's a real concentration of institutional landlords in Toronto that have capacities to build great buildings, to provide great environments. And then there's also this other group, for whatever reason, have these assets that are functionally obsolescent. And beyond leasing, I think going into next year, we're going to see a little bit more opportunities. This is just what I'm predicting in terms of investment opportunities. There's going to be a real kind of inflection point where landlords are going to have to make decisions if they're going to invest and take an opportunity risk in terms of trying to lease, or if they're going to sell. And traditionally, over the course of the last 2 years, Toronto's been a tough market on the investment side. The price per pound's been high. I think we're going to start to see some B and some C class buildings start to come to market for opportunities.
So we're going to stay with that a little bit. I'm going to come to Alan quickly. Do you think tenants are there to pay, premium for certain space and quality of buildings right now. Obviously, we touched on cost mitigation being a huge factor through the pandemic to date. What are you hearing?
Yes, and it's always been the case, right? There's, if you think about buying a car, there's always been a Rolls Royce, and there's always been, a Kia or whatever the version might have been 40 or 50 years ago. So there's always an audience. What we're seeing, John, which I'll pass on to the viewers here as well, is the concept of healthy buildings are in some cases surpassing and actually becoming what we used to classify as AAA class buildings. So just because you're in a tower in downtown Toronto, nothing against the towers, because most of them are well capitalized, the owners are extremely well capitalized. They've been reinvesting in the buildings to keep them up to LEED Platinum standards and beyond. But what's opened up in the marketplace is, just use Portland Commons with Carterra as a perfect example. It's not right in the downtown core. It's only 550,000 square feet, not 2 million square feet. But what they've focused on is the health and the well-being and the accessibility and the sustainability factors that Gord was talking about, in order to utilize those as amenities for companies who are trying to hire diverse employees to supply those amenities to inside of the building, obviously, for employee attraction and retention concepts. And in cases like that, we're our tenants, when they can find those sort of rare opportunities, and they know that the productivity of each employee individually occupying a desk 2 days a week or 5 days a week or 7 days a week is going to go up significantly, producing top line revenue for the corporation and positive EBITDA growth for the organization, because the building is healthy and the people are more productive. They look at that and they say, what's another $1 or $2 a square foot if I'm going to get another $100 million of revenue out of the productivity of our employees? So the answer is clearly yes.
Interesting. And this kind of is a good segue into, we can't have a discussion about the Toronto office market without talking about new supply, Nick. And we've got a significant amount coming on, close to over 9 million square feet committed for, which a lot of it, over 80%, as we know, is pre-lease. But how does that stat make you feel as an investor, have a big investor in this market?
Hey, John, and on the demand side, clearly there's a lot of uncertainty, and I think I heard the stat from Alan earlier that most companies are forecasting, probably optimistically, by end of year to be 90% back in the office, which by implication is 10% not, which 10% less occupied space, if that translates into longer term commitments, would have as an example, a devastating impact on the market. I'm not suggesting that's the case, but if that becomes more semi-permanent as leases roll and tenants make decisions, that can have an impact. The supply side, we've got a lot more visibility, and this is sort of the double-edged sword of a really successful market. Is rents go up, vacancy goes down, and the development pipeline responds. And the way it works in office, especially in downtown office, is it takes 3 to 5 years to put a big building up. And so you can see it coming from a mile away. And guess what? Now it's delivering, and it's probably not the most opportune time to be delivering, as it typically is from a cyclical perspective. However, the new buildings, to the earlier comment about flight to quality, resonates, and for the most part, really well leased, and in some cases, 100%, but quite high pre-leasing, and that's fantastic for those building owners. What does that mean for the market? Because clearly all those tenants are coming from somewhere else, and I'd love to throw the question back to you, John or Alan, is what's the leasing of that backfill space? Because we don't know what that vacancy looks like on that space, and that's a huge number potentially, if it's not taken up by new absorption, not existing tenants moving from one space to another, but new absorption has to happen to mitigate the fact of that new supply. Otherwise, that new supply, pre-leased or not, is an additive to the market vacancy.
That's right. Yeah, it's a great point, Nick. And I'm going to stay with you. You're not free yet for breathing room, but I'm going to stay with you on the theme around traditional leases versus non-traditional, and the rise and the request for flexibility. And we've certainly seen the need to be flexible, and landlords and tenants for the most part have been working through some pretty flexible deferral arrangements through the crisis. But going forward, is this, as a major investor in the commercial real estate space, not just in Canada, but globally, we think back to the basic kind of financial underwriting aspects of commercial real estate and traditional long-term leases and strong covenants and that value, versus kind of a long, shorter-term profile. What are your thoughts on that as a major investor? going forward, changes in the leasing structure?
So maybe just a couple of quick comments. First off, one of the things we think about is cyclical changes in the market versus structural changes in the market. And one of the structural changes that's been happening over the last 20 years, John, to your point, is lease lengths have shortened. You know, traditionally look at the UK market, sort of in the older, more mature markets, 20, 25-year leases were quite common. Now they've come down quite a bit, and that's been an ongoing trend. Also, on the occupier side, flex office providers have, increased dramatically in the last number of years to be, whether it's technology tenants or flex office is the biggest occupier or take up of space in major markets globally, has clearly resonated with tenants. Now, the downside obviously is you don't want the time you don't want to short leases in a down market, and as a long-term conservative investor looking for steady cash flow, you want leases that get you through the down periods, and you're willing to sacrifice some of that upside on the upswing. Whereas, I really view flex office providers almost a derivative of the long lease, in that there's more opportunity to roll rents faster, but they roll both ways, both up and down. So from an underwriting perspective, it adds volatility unequivocally, and so with that comes a risk premium involved, because it puts in more uncertainty and on a short-term basis. But I do think we have to acknowledge that is a long-term trend, and it's going to be more commonplace, and it's going to factor in. And I think what it comes down to is who pays for improvements, and how does that work in rent, and what's the trade-off, term versus financial, because we know the cost of build-out is large. It's part of the reason long-term leases, it's amortized over a long time period, and that keeps the rents competitive. If the tenants are willing to pay for a bigger proportion of that, that's something to be discussed. Also, how much does a tenant value their location and the brand equity and the ability to sort of not be churning space constantly and have some security of tenure as they think about growing their business over time. So I think that's a suitably ambiguous answer of, I believe it is a long-term trend going to shorter leases, but how that plays out both in the capital markets and in the leasing markets as it relates to the financial implications, we're going to see how that plays out, because we've now just gone through a time period where a lot of the flex office providers have declared bankruptcy and or had their business model shattered in the short term. So how that plays out, who provides it, who pays for it, is going to get shuffled out in the next year or two, I think.
There's some excellent points there, Nick, and I'm going to go around the horn on the same question to everyone here, because it's such a key topic right now of discussion. And before I come to you, Alan, on the occupier aspect, I'm going to go to Gordon just for the dream view here on the kind of long-term leases and versus the kind of structural versus cyclical changes, as Nick turned up.
I think in this period, like just speaking of my portfolio, I've been very fortunate. A large portion of our portfolio is allocated to the government. We've got some banks in there as well. So we've got long-term good covenant leases. I would say that our lenders and our partners in the banks have been great throughout this, kind of uncertain period over the last little while. The cost of capital has never been cheaper. And, the debt covenants and the abilities for approvals, I think have been tremendous. So kudos to them. But getting back to about flexibility, I think there's a real opportunity to accrete value on the rent side by giving more flexible term. And I think it was at Scotia Plaza, I saw this incredible program. I think it was Ready, Set, Go is what it was called. And it was these turnkey model suites, like really high end, really well appointed, and plug and play suites. And what I'm hearing from the brokers is these are really in demand. We're looking at our portfolio right now and setting up a number of these type of units as well too. And people are going through and they want to see some plug and play units, especially in a transition period like this, where they're uncertain. To Alan's point earlier, they're making decisions on occupancy. This just makes the decision a little bit easier. There is the trade-off in terms of term, but you pick it up on the net rent, and people have been demonstrating that they'll pay for it.
Yeah, and same question to you, Alan. And obviously, Agile is picking up as significantly on the occupier side of our industry. But what are your thoughts on the debate?
Well, I'm in a unique position, John, because this is where I go from anecdotal to actually evidentiary. So I was a tenant. I owned a business for 20 years, and I rented 4,000 square feet from Oxford, a fantastic landlord at 120 Adelaide West. And when we were looking at that building, we were up at 2 Bloor before in a built-out suite. When we were looking at moving downtown, Oxford had built out this show suite for us, so it reduced the amount of time we had to wait for something to get built out. And we looked at it and we said, okay, so we could take this at a little bit of a premium, but they're only requiring us to sign for a 3-year lease. And at that time, my old company, Mckenzie, we were quite a bit on a growth mode. We were taking on a lot of business across the country, and we didn't know if we were going to be 10 people today or 25 people at the end of this lease, and how we were going to do it. So we ourselves paid for the flexibility, and we're experiencing now, from the JLL perspective, representing tenants, we're experiencing the exact same thing, and these are the same comments, that there is a premium to be garnered. A number of tenants, especially what I would call the early stage tech tenants, who are in such hyper growth mode and don't know if they're going to go from 100 people to 2,000 people inside of a 3-year span. Mckenzie was way different than that. Needless to say, we weren't tech, but they don't have a choice, but they have to pay the premium in order to gain the flexibility. There's no choice, or else they can't run the business.
Yeah, it's some great points there, and it's clear, obviously, that's coming back here is the future is definitely not binary for office. They're going to have to move flexibility more all around. There's been a lot of obviously discussion around health and well-being, and certainly in the media and across our industry, around treating tenants more as as consumers of the product, rather than providing an essential service for an office building. What are the views there going forward on improvements? Gord, you talked on air quality earlier, and technology has been a big component, obviously, for us all as we've been navigating kind of coming into the office. But over to you, Gord, in terms of thoughts on the evolution of more of a consumer product.
Yeah, I touched a little bit on M&E systems and touchless fixtures and UV technologies. Like, that's all table stakes and low-hanging fruit. I think where landlords are going to win the day goes beyond bricks and mortar. And they have to focus on operational improvements too, enhanced cleaning, community, building a sense of community and communication, real-time contact and KPIs for service, really measurable, so you can demonstrate it to the tenants, because tenants are very sophisticated, and they're getting more and more sophisticated in terms of the quality of their buildings, and brokers play a large role in that too. And what we're trying to do and what we're seeing is smart building technology. Tenants have their own ESG mandates. They have their own sustainability goals. They have their own corporate and community stewardship programs. So they want to know how much consumption they're using in the building in terms of energy and carbon footprint. So being able to demonstrate that you're a good environmental steward, that you believe in sustainability, you have a good program. I think that's what tenants are going to covet, because they want to align their brand with the space that they're in. And I think we're going to see that a lot going forward. And I think it's going to be a real emphasis on landlords, and it's going to be incumbent on landlords to really demonstrate how they're making a difference with their building and how it's adding value to the tenant.
Great points. And I'm just conscious of time, and I do want to get this rapid fire closing that I promised you all at the end. But just before we go there, Nick, I'm just going to turn to you on capital flows quickly, just before we close out here. Obviously, institutional money's been kind of fairly quiet on the sidelines over the course of 2020, as we kind of trying to figure out the trajectory of this and the impact of the virus on the office sector specifically. And private capital has been very active. If there's confidence around the underwriting of that income profile, do you think we could be in a place where cap rates not only go up, but actually go down and compress further, given where we are with the underlying cost of funds and the risk-free rate?
Topic, but fundamentally, I think you're right that that's a real possibility. What we've seen in the capital markets writ large is obviously a pause in 2020 as investors generally looked inwards as opposed to outwards for investment opportunities. But then what's come out is, especially with folks on office markets, really a bifurcation of either core high quality assets you want to own long term that have secure income streams, and you can look through the short term volatility, and if that has a mark to market impact on valuations, you're willing to live with it because that's inherent in the nature of owning assets long term. Or, interesting enough, development sites have in our experience have not moved at all from pre-COVID to post-COVID in a positive sense, in terms of they've maintained their value with that underlying view to that the future tenants are going to be looking for great quality, best in class assets and design of the future, which I do always sort of say a bit tongue in cheek, because if we knew the future we could just do it now, but the whole future proofing concept. But fundamentally delivering high quality spec, especially in older, more established markets where the stock is maybe a bit older, has seen demand. And it's really that midsection, the sort of mid to lower quality, shorter term weighted average lease term that you're seeing less demand in general, I would say. But you make a great point. One thing we talk about, in the markets, the nominal cap rate, with the deal, is it going up or down? And intuitively, you think the cap rate should move up given uncertainty in office markets and leasing demand. And lots of good rationale and logic, talked about on this call today. But frankly, we don't know where it's going. And I've heard one tenant say, we're in the fog of war right now, or the eye of the storm. They don't even know when they're going to be back in the office, let alone what their future requirements are. So that has to filter into the uncertainty premium. But it's also important to note from an investor perspective, the underlying, bond rates and the risk-free rate, where fundamentally you're pricing real estate off of, have dropped dramatically in the last 12 months. And so really the spread, which represents the risk premium you're getting paid for the real estate, is actually wider, notwithstanding the cap rate hasn't moved. And so you could certainly see a scenario as the occupational markets play out, and especially obviously in a positive sense, that the certainty and comfort around underlying cash flows becomes more certain. The risk premium should shrink, and if we're in a lower for longer interest rate environment, that could see lower cap rates. That being said, the last 2 weeks might be a counterpoint to that lower for longer interest rates, and we've seen that really bounce around. But fundamentally, I think most people see the cost of capital really remaining low for the near to midterm for a whole host of macroeconomic reasons.
Thanks, Nick. Yeah, definitely. Certainly one to watch, and the learning continues. Right, we've got about just about a minute left before we have to shift, and I'm going to do a really quick rapid fire close. We've covered a lot here, a lot of ground, some great insights, but I can't resist the first question, and I'm going to go around the horn quickly. Is the office dead, or will people return to the office? Nick, you can kick us off.
It's a big difference if it's 80 or 85% versus 95 to 100% what it was prior.
Perfect. Gord?
No, it's not dead at all. People are returning. I think there's some pent up excitement, and it's just a matter of time.
Alan?
Again, separating the fact from the fiction. The facts are, we've done the research. The research says that in 11 countries, 362 companies in 9 different industries, that they're going to get back to 90%. I would not be surprised if it ends up a lot higher in the Toronto market than some of the other areas that we were. So that 90%, Nick, was very much international, not just Toronto centric. I personally believe that we're 95 to 98% in Toronto.
Great response. And then where do we expect downtown vacancy at the end of 2021? Alan?
It's going to go down, in my opinion. I think companies are coming out of COVID. I think they're going to take back space that's on the sublet market. I think there's pent up demand that's going to get absorbed in the market, both direct and sublet. So it's going to go down.
Gordon?
Yeah, I think on aggregate across all classes, it's probably going to stay flat or go down a little bit. I think it's going to get a lot tighter in the quality A class space. And then I think in the B and the C class market, I think you're going to see a little bit of softening going towards the end of the year. But on aggregate, I think it's going to come down a bit.
And Nick, finally, are we down?
With the caveat, we are in extremely uncertain times, and so this is really a lot of guesswork and sort of triangulating. But if you're talking about the very short term, between the impact of new supply and uncertainty of tenants making growth decisions, I think the vacancy rate's higher at the end of this year than it is today.
So we've got an up, a down, and a flat. Look at that. We couldn't be more diverse if we tried. Okay, well, gentlemen, we are on time now, and so I want to thank you all for a great panel discussion. We obviously could have carried on for a lot longer. So much to unpack there, and obviously quality screams there, and we're hearing obviously tenants will certainly pay for it, and so it's going to be interesting to watch the kind of class of buildings as we go forward. But just a reminder to everyone as we close out the session that please click on the link in the chat room to access the next stage for the panel rooms. So as you can see now, it's been brought up on the presentation. You can access here or go into the chat room, and that'll take you through to the next 30 minutes of discussion. So thank you everyone for the time. That was a great session, and thank you gents on the panel.